Today, we will talk about long-term equity anticipation securities, LEAPS. LEAPS are publicly traded options contracts with expiration dates that are longer than 1 year, and typically up to 3 years from issue. They function just like other listed options, except with longer times until expiration. A LEAPS contract gives a buyer the right, but not the obligation, to purchase or sell the underlying asset at a predetermined price on or before its expiration date. LEAPS are no different from short-term options, except for the later expiration dates. Lengthier times until maturity allow long-term investors to gain exposure to prolonged price movements. Investors pay a premium for the ability to buy or sell above or below the option strike price, which is the decided upon price for the underlying asset at which it converts at expiry. Each put or call options contract equates to 100 shares of the underlying asset, and investors must understand that they will be tying funds up in these long-term contracts. Index LEAPS allow investors to hedge and invest in indices such as the S&P 500. They give the holder the ability to track the entire stock market or specific industry sectors and take a bullish stance using call options or a bearish stance using put options. Investors could also hedge their portfolios against adverse market moves with index LEAPS puts. Premiums for LEAPS are higher than those for standard options in the same stock because the further expiration date gives the underlying asset more time to make a substantial move and for the investor to make a healthy profit. Known as the time value, option marketplaces use this lengthy time frame and the intrinsic value of the contract to determine the value of the option. The option contract has a basis of 100 shares of the asset, and other factors affecting the premium price include the volatility of the stock, the market interest rate, and if the asset returns dividends. LEAPS allow long-term traders to gain exposure to a prolonged trend in a particular security with one trade, without needing to use a combination of shorter-term option contracts. Short-term options have a maximum expiration date of 1 year, and without LEAPS, investors who wanted a 2-year option would have to buy a 1-year option and simultaneously purchase a new 1-year options contract. LEAPS calls allow investors to benefit from potential rises in a specific stock while using less capital than purchasing shares with cash up front. Similar to short-term call options, LEAPS calls allow investors to exercise their options by purchasing the shares of the underlying stock at the strike price. LEAPS calls also let the holder sell the contract at any time before the expiration, and the difference in premiums between the purchase and sale prices can lead to a profit or loss. LEAPS puts provide investors with a long-term hedge if they own the underlying stock. Put options gain in value as an underlying stock's price declines, potentially offsetting the losses incurred for owning shares of the stock. LEAPS puts help investors benefit from price declines without the need to short-sell shares of the underlying stock, which can be extremely risky. LEAPS have benefits such as providing long-term exposure to a security with one trade and helping investors effectively hedge against adverse market moves. However, they also have downsides, with investors needing to put up more capital up front and these contracts often costing more than traditional options. An example of using LEAPS would be an investor purchasing index LEAPS puts on the S&P 500 to hedge against adverse moves in their portfolio. If the index falls below the strike price by the expiration date, the LEAPS put will increase in value, helping to offset the loss in the portfolio. If the index rises, the LEAPS put option will expire worthless, and the investor would be out the premium paid. LEAPS are long-date call or put options listed on stocks or indexes and will have higher initial premiums than shorter-dated options. They also lose value over time, but for some investors, LEAPS may provide a more affordable way to take a long position than purchasing the actual stock. If you have a medium-term time horizon, then a LEAPS call may be a good speculative bet on a stock that you think will rise. Yes, LEAPS involve risk, and you can lose up to your full investment when purchasing one if it ultimately expires worthless. Selling LEAPS is also risky as you are exposed to theoretically unlimited losses if the underlying security moves against you. Yes, when LEAPS are sold at a profit, the gain is taxable. If the LEAP contract was held for at least 1 year and 1 day, the taxpayer will be taxed at the long-term capital gain rate. If the contract was held for a shorter time, the taxpayer will be taxed at a short-term capital gain rate. The downsides of LEAPS include needing to put up more capital upfront and these contracts often costing more than traditional options. Launched in 1990 by the Chicago Board Options Exchange to meet investor demand, LEAPS are a mainstay of options trading. They come with unique risks and rewards, and investors should understand the potential risks of trading them. Here are 4 key takeaways. 1. Long-term equity anticipation securities are listed options contracts that expire in more than a year. 2. LEAPS can be listed on a particular stock or an index as a whole. 3. They are often used in hedging strategies and can be particularly effective for protecting retirement portfolios. 4. LEAPS have higher initial premiums than shorter-dated options and lose value over time, but may provide a more affordable way to take a long position than purchasing the actual stock. Hope this would help. Thanks for watching.